the silent trade-off that bound banks to their governments. It didn't happen overnight. There was no vote, no announcement, no single decision. Just a quiet exchange that reshaped European banking forever. To understand why this trade-off still matters today, we have to look beneath the surface. Because long before crises erupted, a deeper relationship was forming, one that promised stability, but quietly rewrote incentives across Europe. After integration accelerated, governments faced a new reality. They needed constant access to affordable funding. Social systems expanded, public investment grew, and debt became a permanent feature, not a temporary tool. Banks were the natural buyers. They needed safe assets. They needed predictable returns. And regulation gently nudged them in one direction. Sovereign bonds fit perfectly. They carried low capital requirements. They were liquid, familiar, and politically neutral. On paper, they were risk-free. For governments, this solved a problem. Debt found a reliable home. Borrowing costs stayed contained. Markets appeared calm. For banks, it solved another. Balance sheets looked stronger. Returns improved without obvious danger. Capital ratios benefited from favorable treatment. Everyone gained something. And because everyone benefited, few questioned the arrangement. But this was not a simple partnership. It was a dependency forming in slow motion. Banks grew sensitive to government stability. Governments grew reliant on bank balance sheets. Over time, the distinction blurred. State health influenced bank strength. Bank health influenced state credibility. Each began to reflect the other. At first, this alignment felt efficient. National systems appeared coordinated. Policy transmission improved. Financial control seemed tighter than ever. Yet efficiency often hides trade-offs. The more banks absorbed government debt, the less room they had to absorb anything else. The more governments relied on banks, the fewer alternatives remained in moments of stress. What looked like mutual support was quietly becoming mutual exposure. This connection would soon redefine how crises spread, not through markets alone, but through the balance sheets meant to stabilize them. And once that bond was in place, there was no easy way back. As the bond deepened, its risks remained largely theoretical. After all, governments had taxing power. They controlled currencies, budgets, and institutions. Default felt unimaginable inside an integrated Europe. This belief shaped behavior. Banks increased their holdings steadily, not dramatically, not recklessly, but persistently, quarter after quarter. Regulation reinforced the pattern. Capital rules favored sovereign exposure. Stress scenarios treated government debt as stabilizing, not volatile. Risk models internalized the assumption of safety. Meanwhile, governments adjusted too. Debt management strategies leaned on domestic banks. Issuance schedules aligned with banking demand. The financial system became an extension of fiscal policy. This alignment reduced short-term pressure. Borrowing costs stayed low. Markets remained orderly. Political trade-offs felt manageable. But hidden beneath the calm was concentration. Banks were not just exposed to governments. They were exposed to their own governments. Geographic diversification narrowed without appearing to. When conditions shifted, this concentration mattered. A fiscal concern became a banking concern. A banking concern became a sovereign concern. Stress traveled back and forth, reinforcing itself. Funding markets noticed a linkage. Bank risk was priced alongside state risk. Credit spreads moved together. Distinctions blurred in moments of uncertainty. What made this dynamic especially fragile was that it operated through trust. As long as confidence held, everything functioned. Once confidence weakened, feedback accelerated. Attempts to break the link were cautious. Diversification was encouraged, but not enforced. Structural change was discussed, but deferred. The trade-off had become embedded. Breaking it risked destabilizing both sides. Leaving it intact risked amplifying future shocks. Policymakers chose balance over rupture, and so the system continued. Stable on the surface, tightly bound underneath. A relationship designed for efficiency was slowly becoming a channel for contagion. The true test of the bond came when pressure stopped being abstract. Markets began asking questions that models never had. What if governments could falter? What if support was not unlimited? What if safety depended on perception alone? As doubts surfaced, reactions were swift. Bank funding costs rose alongside sovereign yields. Investors no longer separated institutions from states. They assessed them as a single balance sheet. This convergence accelerated stress. Banks faced declining asset values. Governments faced rising borrowing needs. Each weakened the other without deliberate action. Authorities moved to contain the loop. Support mechanisms were expanded. Supervision intensified. Communication became as important as policy. But credibility is not built instantly. Every reassurance had to overcome visible strain. Every intervention signaled both strength and vulnerability. Stability depended on timing as much as substance. Banks adjusted their behavior. They shortened maturities. They prioritized domestic exposure. They reduced activities that depended on volatile funding. Governments adjusted too. Fiscal discipline became a signal to markets. Budgets were framed as commitments, not choices. Policy flexibility narrowed under scrutiny. The system survived, but it changed. Risk-taking became constrained by perception. Integration slowed under pressure. The promise of shared stability fractured along national lines. What emerged was not collapse, but a redefinition of safety. Safety was no longer about asset quality alone. It was about political capacity, credibility, and coordination. The bond between banks and governments endured, not because it was optimal, but because unwinding it carried its own risks. And so Europe learned a difficult lesson. Some trade-offs once made cannot be reversed without creating new uncertainty. The climax was not a collapse. It was an acceptance. Europe recognized that the bond between banks and governments was no longer a temporary arrangement. It was structural, and structures shape behavior long after crises fade. Support mechanisms became normalized. Risk assessments quietly incorporated state backing. Markets learned to read policy signals as financial indicators. The boundary between fiscal health and banking stability blurred permanently. This interdependence delivered calm in moments of stress, but it also narrowed choices. Policy errors carried heavier consequences. Confidence shocks traveled faster and farther. The system became resilient in one way and vulnerable in another. It could absorb pressure through coordination, but it struggled to isolate failure. This is the trade-off Europe lives with today. A banking system protected by its governments, governments constrained by their banks, stability maintained through mutual reliance. The lesson is not that the bond was a mistake. It is that every solution creates a new exposure. Every safeguard shifts risk somewhere else. Understanding this relationship matters now more than ever, because future shocks will not ask whether the system is strong. They will test whether it can adapt. Sometimes, the smallest shift in perspective becomes the beginning of a new future. The